Hi, welcome to Joseph Savage. I'm Savage Corner. Hi, welcome to Savage Corner, where finance and crypto meet. My name is Joseph Savage. Today, I'd like to talk to you about managing risk in a world gone mad. Have you ever noticed that life is what happens when you make other plans? You can be going about your life, everything is amazing, the rent gets paid on time, the electric bill is paid automatically out of your checking account, and then suddenly your electricity app decides to charge you $14,000 for a month of electricity. Is there something we could do about that? Okay, I know that that was an actual situation or scenario that happened for a lot of people. And that situation actually happened to utility customers in Texas because they didn't understand the financial risks that they were taking. They signed up for something that would give them cheaper electricity, and they didn't understand the implications of that. And to be honest, I haven't seen any evidence that the people that made the app understood the risk that they were requiring their customers to take. We definitely want to manage risk or have a risk framework that makes it so that risk management removes risk from our lives instead of adding risk to your life. So to me, finance is all about risk management. I wanted to start out with managing risk, understanding risk, because understanding risks is the cornerstone of finance. Everything else that happens in finance is around tools that better facilitate the management of risk. For me, that broad risk framework starts with fundamentals. So you've heard the fundamentals. This isn't a fundamentals channel. Build a budget, pay for credit cards, etc. At a certain point, you begin investing. And when you invest, you're flipping the framework over because you are taking on risk instead of removing risk. So if finance is all about managing risk and removing risk in your life, then why are we investing? Why are we taking on additional risks and bringing that uncertainty into our lives? And the short answer to that is we're doing that because that helps us better manage a broader tier or category of uncertainties, which you could think of as career risk or job risk. If something happens, if you lose your fingers, for example, can you still do your job? Would your employer be patient with you learning to use Excel with a pointer and not with your hands? And yes, I realize that there are legal protections if you have an accident, but employers can and will find ways of getting around that. Oh, your performance has degraded, and we don't think that it's because of your whatever, blah, blah, blah. I don't want to get too far down that rabbit hole. The rabbit hole that I want to get down into is when we are adding risk, adding uncertainty in our life by investing, can we have a life-changing outcome without bringing devastating downside risk into our lives? This is an important question. You hear a lot the phrase, don't risk money that you can't afford to lose. Okay, that's great. How do you know if you can't afford to lose any? How do you know how much money you can't afford to lose? So when we approach that from a broad risk framework, we can say, okay, these uncertainties are met by I have life insurance, I have renter's insurance or homeowner's insurance. I paid down my credit cards, so I have that buffer. I have maybe a little bit of a savings cushion. I'm ready to start investing, but I don't know how much I can afford to lose. Or maybe I'm in a situation where I have never had the extra resources to do any of that, but I want to start learning about some of these financial tools, because if I bring those skills into my toolbox, it could actually increase my earning potential. And can I do that in a way that doesn't have a major downside risk on my personal financial situation. All of the things that we're talking about, how much are you risking? What is the potential benefit? Can I have life-changing outcomes where it's life-changing on the positive side without being life-changing on the negative side? I don't want to raise my toddlers on a street corner just because I bought too much Bitcoin or whatever the situation is. Okay? So I want to make sure that the basic framework of my life is covered. I have a minimum lifestyle requirement. I know that I wouldn't be happy. I would be very upset if my lifestyle dropped below a certain level. Okay? So I want to settle my lifestyle to that level, and I want to put a lid on it and try to keep my expenses at that level. And then as soon as my income rises even a little bit above the level required for my minimum acceptable lifestyle, that little bit extra, that's money that I can afford to lose. And I know that I can afford to lose it because if I do, the rest of my life is not in cataclysm. The shock is not too great. And depending on the level of uncertainty in other aspects of my life, I may need a bit more of a cushion, right? So if I know that things aren't going great at work, I should have a bigger cushion. Because if I invest this money and I lose it, and I'm stressed out about that, and it causes my performance at work to degrade a little bit more, and I lose my job, now suddenly I've lost my cushion. I've lost my job that I needed the cushion for, and I have cataclysmic lifestyle shock. So I want to frame everything in my life around these minimum acceptable levels, minimum lifestyle, minimum viable product, minimum investable criteria, right? And then when I'm looking at investments, I'm thinking about what I call asymmetric outcomes. An asymmetric outcome would be a life-changing outcome, positive reward, without life-changing negative risk, okay? And there are various ways of doing that. But asymmetric outcomes are one of the things that are most attractive about the crypto space from an investor perspective, because I can risk a little bit, I can take a little bit of this cushion, and I can choose a new project that I think has incredible potential, and I can invest into that project, and maybe if I don't have very much investable money, I can invest time into that project instead. I can get engaged with the DAO. I can test out protocols. I can start getting some airdrops, and those airdrops give me a little bit of more resources to work with. And I can leverage my time and energy and the small amount of financial cushion that I have and build toward an asymmetric outcome, where if it all goes to pieces, my lifestyle risk is minimal. I still have a decent job. I'm still hitting my performance goals at work. My babies are fed. My babies are crying. And things not working out with a small Bitcoin investment or a small DeFi protocol investment doesn't have a negative outcome in my life in the sense of my whole life changes, even if it has a negative outcome in the sense of, well, I thought I'd be driving a Lamborghini and now I'm not. So that's a key component in terms of investing time and money and finances. What does your potential payoff look like compared to what's your downside? Okay. And we're looking for asymmetric opportunity outcomes or asymmetric outcome opportunities. You'll sometimes hear it described as asymmetric risk because risk can be positive or negative. I'm risking amazing potential. I'm risking a little bit of downside. That's asymmetric risk. So then that cushion, that how much you can afford to lose, pair that with asymmetric risk, and we start looking at fabulous opportunity. From there, the next question in my risk framework is, how do you allocate risk across a portfolio? how should I manage risk and position sizing? And there's basically two schools of thought around portfolio management or risk management. One is diversification is key. You should diversify across a lot of things so that if one of them doesn't work out, one of the other ones will perform well. This tends to be the cornerstone or basis of venture capitalist investing. They'll invest in 20 or 30 projects. 15 or 20 of them end up not working out, and one of them hits a home run, and the total performance of the portfolio ends up being really, really good, right? That kind of diversification is the focus for venture capitalists. And if your allocation is your time instead of your money, if you're getting involved in DAOs and looking to capture asymmetric risk by getting deeply involved with a DAO and capturing more value from that DAO, then again, you want a narrower opportunity set. You want to find your top 2 or 3 DAOs and focus in on those, or maybe even your number 1 DAO and focus in on that, so that people within that start to recognize you. They know your face, they know your skill set. And after a certain point in time, you can ask yourself, are they giving me the opportunity that I'm looking for within this DAO? Am I getting the level of rewards that I'm looking for after having put in 60 or 90 days of effort into this DAO? If I am, that's amazing. I've built an income stream with an asymmetric opportunity set. If I'm not, then maybe it's time to move on. Because if I've spent 90 days putting 10 or 20 or 40 or 50 hours a week of effort into something, and I'm not being rewarded for that, then either my efforts aren't as good as they think they are, or that DAO is not well positioned to recognize and reward the value of my efforts. And in either case, it's time to move on. Maybe it's time to move on to building new skill sets. Maybe it's time to move on to find another DAO that recognizes the skill sets that I actually have. If I have done that 3 or 4 times and I'm never capturing any value after 90 days, maybe it's me. And if it is me, then I need to get a better feel for what skill sets these groups are looking for and whether I can build those skill sets. Unless you're really good at identifying asymmetric outcomes, it's really hard to diversify across multiple opportunities in a way that actually moves the needle, in a way that the one that has an amazing outcome isn't actually compensated by all of the rest going to zero, doing nothing. So from that context, if you take on more opportunities and have some minimum investable threshold, so certain criteria that have to be met, there's a lot of opportunities out there. Some of them are amazing, some of them are terrible. You can have a short checklist and say, well, I want to know who the team members are, or at least I want to know what their backgrounds are, so that I can evaluate whether they have the expertise to manage security of this protocol. I want a project to have decent tokenomics. So it has to have a token, and I have to be able to look up and understand the tokenomics. Those have to be consistent and not subject to change. Or if they are subject to change, the process to change those is clearly defined. That might be a minimum investable criteria. And you follow that and you evaluate the project space, and that gets you down to a few dozen or maybe a few hundred, depending on how strict your criteria are. And from there, you can then take small positions across a lot of different opportunities. If you're using some of the cheaper transaction cost blockchains, you can take very small positions and say, hey, it's a $10 position and maybe it goes to 1,000. Or, it's a $1,000 position and maybe it goes to 100,000. Versus if you're looking in the DeFi space on Ethereum, for example, you probably want to be taking a little bit larger position sizes just because of the gas costs. You don't want a $100 position, maybe a $1,000 position, maybe a $10,000 position, or take a $1,000 position that you plan to hold for long term and look for the cheapest gas possible. There are ways of finding cheap gas prices. Is it a Sunday afternoon when the markets aren't going crazy? So once you have an understanding of how much you can afford to lose, and you've built some capability of evaluating what could potentially be asymmetric outcomes, and then you're allocating your risk across that portfolio, you start thinking about things like position sizing. And your position sizing really comes down to your level of confidence in the way that you are allocating risk across your portfolio. So if you're doing full-on deep dive long-term positions and you're using a risk moat, so what are the fundamentals of this protocol? What are the drivers that I see for it to actually be adopted and continue to grow? Do I think that it's has product market fit? The more in depth that you're able to build your knowledge on a protocol or a token or a project, the more consolidated you can get. If you're trading on price action and technical analysis, then what your trading really is about is a statistical edge or statistical arbitrage. 54% of tokens that exhibit this price action go on to get a 100% increase over the next 90 days, right? I don't have that holy grail. But if I did, then I'm looking at what is my risk of ruin? What size of position allows me to be wrong, whatever percentage of the time I'm going to be wrong, and still result in a positive outcome over my entire trade set. So lots of smaller positions if my approach is statistical or technical analysis based. A few larger positions if my approach is fundamentals based, built on a confidence and understanding of the protocols. So that is how I then allocate my money I can afford to lose across the position set. So those are all topics for future discussion and videos, and we'll dive more deeply into basically everything that I've talked about today at some point in the future. But I wanted to start with a broad risk framework, minimize lifestyle risk, and then build a cushion that becomes your basis for what can I afford to lose. Look for asymmetric opportunities so that I can turn that narrow cushion into a much broader cushion. And then if it gets broad enough, then I can begin raising my lifestyle. I hope that you enjoyed this. I enjoyed making it. Like and subscribe. If you prefer to read your information, subscribe to my newsletter. We send out the transcripts for all of the videos that we publish. If you have a question or comment, please message me. Please comment below. I'm very interested in hearing what you have to say. I love having conversations about finance and crypto. That's why I started this channel. They're topics that bring me joy, that I've spent a lot of time studying. I love to hear perspectives that are different than I've already heard. I like to have my own perspectives challenged. So if you think it was great, keep that to yourself. I'm just kidding. If you think it was great, let me know. If you think it was terrible, definitely let me know. I want to know why, so that I can think about what's wrong with my mental framework. There's nothing wrong with it. Like, follow, comment. See you next week. Thank you for joining me on Savage Corner. Again, my name is Joseph Savage. I'm your host. This has been Savage and Corner, This has been Savage Corner. Can you reset again?